Hello, this video is to talk about what we have for this week. So basically, we'll be looking at chapter 3. And in this chapter, we'll be covering product costing and cost accumulation in batch production environment. So the key learning objective for the course are highlighted in D2A. You would already have access to that. And this topic, in as much as it tends to have a broad coverage of product cost, but it does emphasize on job costing. We do cover the other type of costing in different costs, and I think one of them we're not going to cover that at all because it tends to be captured in this topic as well, but not excessively, and that is process costing in chapter 4. So next week, instead of chapter 4, we'll be looking at chapter 5. So again, here are the learning objectives for this week. If you like to take a look at it here, but you'll definitely find that in your textbook. Now, in job costing or process costing, or you call it manufacturing, product costing, whatever it may be, product costing generally is estimating the cost of a product. And this product could be tangible or intangible. In management accounting, it is typically separated into two spectrum. We have job costing, which accumulate costs by the job, and then we have service costing, which could either accumulate job costs similar to the job costing or in what we call process costing. So both are important in terms of financial accounting and managerial accounting. In financial accounting, there's a specific requirement in terms of the accounting standards on how you estimate a product cost. And then you have to include certain things that can be traced to that product, things like the direct material, direct labor, and the manufacturing overhead. These specific costs can be classified as product cost, which means other costs that are not directly linked to the production of the product will be considered as a period cost. So that's one important thing that you should have in mind when you study this topic, be able to differentiate a product cost and not product cost. And in most calculations or most examples you come across, you will always find that these costs are separated, where we have the cost of goods sold, which is the product cost, and then you have the other operating costs that are required for the business to carry out the day-to-day function. So how we compute the product cost is very unique in the sense that you have to follow exactly how the accounting standards requires you to follow in order to include it in the financial statement. In management accounting, it could be done differently. And that is why one key thing that you come across, we don't have universal standards for management accounting. So the management will decide what they include as be the product cost. Nonetheless, in a general accounting principles, we have specific items we include in the product cost, which I said earlier, include the material cost, the labor cost, and then the manufacturing overhead cost. So that is the same principle that we will follow in this on this topic and in the entire course. Now, when you look at the flow of cost, the costs normally will come from different journals, and that journals could be the labor journal or the direct material journal. It also goes through to the econ statement. Now you have the work in process here. When direct materials are requisited and then they are issued by the store and it goes into production, there will be a journal that will be updated in the direct material account. And then the value that goes out of the store to for the production will be recorded in the working process. At the same time, when you hire individuals or you have an employee that will need to convert those raw materials to finished goods, the employee cost will be considered as labor cost. And at the time the conversion is taking place, that cost will be part of working process. And then you have the manufacturing overhead costs. The manufacturing overhead costs are indirect costs. They consist of indirect labor or indirect materials. Indirect materials will be things that are not the major materials to carry out production. Let's say, for example, a furniture manufacturing company that produces desks will not consider the glue or the screws that they use for the desk as direct material. But of course, you need those materials to be able to produce a desk. Instead of classifying the cost of those screws and glue as direct material costs, they'll be classified as manufacturing overhead costs. Excuse me. And there's a specific way you allocate this manufacturing overhead cost to the cost of the product. Now, you see here we have work in process or work in process inventory. What does that mean? That is raw material you have taken from the store that is being converted to finished product, and they will sit in the journal as those items are received. And you will also need to credit the work in process inventory as the job you start or the products you start producing is completed, and then they are transferred out to the finished goods inventory. Now, once they get to the finished goods inventory, you debit those items in the finished goods inventory. And once they goes out of the finished goods inventory, then you credit the finished goods inventory. So when it goes out of the finished goods inventory, that becomes what we consider as sales. And the value of the items that we're taking away from the finished goods account or finished goods inventory will be added to the cost of sales. And then from the cost of sales, you use that information to compute your income statement. So basically, the flow of cost in manufacturing firm, the essence of it is for us to be able to trace how the costs move from one journal to another journal and so on, and where can we trace that cost to. Systematically, as I said, all started from direct material, move on to the work in process. From work in process, as they are completed, it moves on to the finished goods account, from their cost of sales, and then the income statement. Now, let's look at this job order costing system. Now, generally, when we talk about the costing system basically means a system that is designed to keep record of cost of products. Remember, as I mentioned earlier, product is not only job, could be job that has to be completed, could be services or products that have to be manufactured. In this particular example here, the job system would be designed to accumulate the cost of each job. What we consider as job in manufacturing, in management accounting, could be services or even production of items that are non-identical, and they are most often very unique to a customer. And therefore, in order to be able to estimate the cost accurately, we have to calculate the cost of each of those services or products we produce as the orders are placed. For example, is your vehicle. When you take your vehicle for maintenance, what you normally see the mechanic do in most cases will be they either sit in the back of computer and they key in all the things you say you want to do for your vehicle, and then include the cost of those items. And then they can add their profit margin to the cost, to the total cost. And then the other thing you could see them come is a sheet of paper similar to what you may have in front of you right here. And then they write down the things you want to be done on your vehicle, and then they estimate the cost. And the cost they will include will be the cost of direct material, the cost of the direct labor, and then the manufacturing overhead costs. In other words, overhead costs, if you just put it that way. Don't forget, this is not the total cost of the job. There are other things that the mechanic did not take note of. Those things are the operating cost, the cost of the rent for the premises, electricity, and many others. And that is why, if they have done their costing system way ahead of time, they could say, our gross profit margin, or the percentage we add in order for us to be able to achieve our profit, which we normally call markup in management accounting, is 30%, which means if your cost, for example, is perhaps say $70, then they will have to add $30 to that. to tell you how much they will charge to you. Okay, that is before tax. So why? Because they've designed a system to record what is going to cost for them to provide you the services or to manufacture the products you request for. Then you have the direct materials here, materials that will be required, and then how many hours of job will be required, and what is the cost per hour for the job that needs to be completed, and the total cost for the direct labor cost. Now, right here in the manufacturing overhead cost, you may have people who may have to dispose some of the things they may remove from your vehicle, and those things are needed for your vehicle to be able to be repaired. So that is a direct labor cost because there's an individual working there that will need to take that and go to somewhere and dispose those items. So that cost will be considered as part of the manufacturing overhead cost. And of course, there's also electricity that they need to be able to fix your vehicle. That will also be considered as manufacturing overhead costs. So all of those costs, if they can estimate it, whatever they build into it, then they will allocate it to you. Normally, when you have the manufacturing overhead costs, it could be allocated using different methods. They could be allocated using machine hours, which means how many hours are they going to operate their machines to produce your item. And based on that hours, they will have what we call predetermined overhead allocation rate, which could be 20%, 50% of whatever it may be, or which could be $20 multiplied by the total number of hours that will be required to produce your products to assign the manufacturing overhead costs to your order. And right here, you have the cost summary. In the cost summary, then you have these various information here, which is the total cost from the direct material, the total cost from the direct labor journal they open, and then the total cost from the manufacturing journal they open. In a practical accounting environment, you may not really have to do this calculation here, because when you create a journal to record the direct material that was issued, that will trigger record in multiple other accounts, which of course goes to the chart of accounts. So automatically, most accounting system will automatically calculate this and tell you this is the cost of the job. Why? Because you've included information earlier as the direct material, you've included information earlier in your payroll, what is going to cost to pay the employee that is going to work there. And then you've also included information earlier, what the predetermined overhead rates, if the overhead allocation is machine hours, and if the rate per machine hour is $9. So you have the total cost for the manufacturing overhead to what you have right here. So basically, this is a straightforward calculation, and I hope you find week 2 to be very straightforward and helpful. But if you do have some question, please feel free to contact me. This is where I'm going to stop for introduction to week 2.